Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this Analyze Out Loud video, I'm going to take a look at the valuation conundrum that I currently see with Aflac. The question I'm going to attempt to answer is it undervalued, fairly valued, or overvalued? As I indicated in the written portion of this article and several times in the past, assessing fair valuation is a puzzle. Like any puzzle, it's comprised of many pieces. And what I'm going to attempt to do here with this video is put the important valuation pieces of the puzzle relative to Aflac together so that I can try to paint a clear picture of what the company really looks like. So starting out here, I have a graph that goes back to 1998 plotting Aflac's earnings per share. And this orange line represents a theoretical fair value PE of 15 no matter where you touch the graph. The first thing I want you to notice is that Aflac from the end of 97 up through 2012 really had an excellent record. They went through both recessions with pretty good operating performance in both cases, earnings growth. I'm looking at adjusted operating earnings here, but I do want you to notice how the earnings have really flattened. So this is part of where the conundrum comes from. You're really looking at two different companies, a very fast growing company up through 2012, followed by a much slower growing company since 2012. And part of the puzzle to assessing fair valuation is the proper multiple of earnings or cash flows, and I'm going to look at several metrics here today with Aflac. But also you have to take into consideration the growth that you're paying or what the value of the future earnings that you might be buying if you bought the stock today might be. And that's where Aflac's a conundrum. It's really a story of two different valuations of the same company. But before I get into price and value, I'm going to add a couple of components to the graph. I'm going to add a plotting of the dividends and the dividend payout ratio. And what you can see here is that Aflac's dividend has increased each and every year through this time frame since 1998. The company's actually increased their dividend every year for 35 consecutive years and is a dividend aristocrat as a result. Or in other words, companies that have increased their dividend by 25 or more years. The company is A- rated. Its debt to capital is only 18%. It has a market cap of $33 billion. And it currently offers a yield of 2.1% and trades at a blended PE ratio of 12.5. Now, normally I would consider a company cheap that's being available at a PE of 12.5, where my basic thesis is that a normal valuation for most companies is around a PE of 15, which is the average PE of the market over spanning almost 200 years. Somewhere between 14 to 16 is normal. And of course, there will be periods where valuations are higher than that and lower than that. But in the case of Aflac, the valuation of this stock, as I'll show you in a moment, has changed dramatically. So next I'm going to plot these dividends on top of the orange line after they've been paid out. And then finally I'm going to bring price into the equation. And what I want you to see here when I look at price, and then I'm going to add the normal PE to this long-term graph. But before I do that, I want you to notice that from 1997 coming into the Great Recession, Aflac literally traded at a 15 PE ratio or higher. In fact, in many cases, the PE ratio over this time frame was higher than 15. It was only occasionally came down to that level. However, since the Great Recession, Aflac's PE ratio has fallen dramatically, and you can see here that 9 and 10 multiples since the Great Recession have been more normal. So now let's add the normal PE ratio and examine it a couple of different ways, and this will give some insights into why I consider this a valuation conundrum. Long term, the normal PE for Aflac has been about 14.8. But I'm going to use the scroll bar here, and I'm going to go back to just before the Great Recession. So now I'm looking at 1998 to 2007. And what I want you to notice here is that the normal PE, or the PE that occurred most often during this period, calculated out at 19.5 times earnings. So this blue line is a PE of 19.5 no matter where I touch it. And as you can see, with the exception of 1998, for most of these years, Aflac traded at a 19 or higher PE. In fact, it got up to a 30 PE or higher just before the recession of 2001. And the market continuously valued that stock more or less around that 19.5 PE. So you could argue that somewhere between, let's say, 16 or 17 times earnings up to 19.5 to 20 times earnings was relatively normal. But I also want you to notice that during this time, Aflac grew earnings at the rate of 11.9%, which is obviously very good. Now, this is my valuation conundrum. This was normal valuation for Aflac coming into the Great Recession of 2008, or just prior to that Great Recession. But as I move these periods forward here, I'm going to go ahead and take this all the way to 2012, because what I want you to see here is that since 2012, Aflac's earnings growth rate has fallen to only 1.6%. In other words, it's virtually no growth over this period of time. But I also want you to notice that a normal PE ratio of about 10 or lower has been the norm really until we got into March of 2016 and then all of 2017, where Aflac now has been trading at multiples above 9.5 or 10. I'm going to use 10 as kind of my benchmark PE, just round this off a little bit. So from a standpoint of more recent history, a 10 multiple would indicate fair value, at least according to how the market has valued the stock. So in this case, a 12.5 PE would actually be overvalued relative to the blue line, but it's still undervalued relative to the normal 15 PE. And just as an aside, there are a lot of utility stocks that are trading at 15 PEs that are only growing at 1 or 2%. So it's still theoretically possible that this could occur. Now, as I mentioned in the article, in 2011 and 2012, I have previously written articles on Aflac. Now, in November 9th of 2011 is when I wrote my first article, so I can't get perfectly on that. I'm going to go within a week here. I can only do monthly closing prices, but this is approximately when I wrote my first article on Aflac, and as you can see, the PE was down to 7 or 8 at that time, which was an excessively low valuation in my estimation. And I talked about how Aflac's fair value PE ratio should double from the 7 up to 15. Well, as I mentioned in the written part, that didn't actually happen, but the PE has gone from 7 all the way up to currently a blended PE of 12.5, and that resulted in a 12.8% rate of return over that time frame. But what I really want you to see here is that rate of return is really a function of very low growth but an expanding PE ratio, where the PE ratio has steadily increased from 7 or 8 up to its current 12.5, and now it's arguable that it could be moving back towards a 15 or higher PE ratio. Now, if it were to move back to a 15 or higher PE ratio, which would be the orange line up here, then that rate of return could actually end up annualizing closer to 14%. On this basis, Aflac would still appear to be undervalued. However, if I shorten this time frame again to this time when it was trading at about a 9.5 PE, Aflac would be overvalued, and if it reverted back to that 10 PE over the course of the next year and a half or so, you could actually have a negative 6.6% annualized rate of return, or as much as an 18% drop in value. So this is where the conundrum is. Is Aflac finally moving back after all these years to a normal, reasonable multiple of 15? Or have we set a new standard where this stock is only worth 10 times earnings? I'm going to leave it up to y'all to decide for yourselves. Now, at this point, I want to reiterate that Aflac's growth rate has slowed precipitously, and there are a lot of reasons for that. What's going on in Japan demographically, and as far as product launches, how fast the U.S. has grown, etc. I'll let you dig into the company's fundamentals yourselves. But the point is, looking at an estimate going forward, there are 13 analysts that are forecasting extremely low growth for Aflac over the next couple of years. And by the way, these analysts have been very accurate forecasting Aflac over the years. This is a summary of how accurate they've been when they were making an estimate 1 year in advance or 2 years in advance. And as you can see, for over 90% of the time, 93% of the time to be precise, Aflac has either met or beat analyst estimates, and it had a pretty good quarter, the last quarter that they did report. Now, this is using a 15 PE as a fair value reference here. This is the orange line in this graph is written with a 15 PE. If I move to the normal multiple that Aflac has traded at over the past 5 years, and I can actually examine that, and you can see that going back 11 years, actually, a 9 or 10 PE ratio has been very normal. So if I use a 10 PE as a valuation reference, then I have this opportunity to see these negative rates of return that I talked about previously. So this truly is a valuation conundrum, and a lot of it now depends on the growth going forward. But I do want to say this, compared to trading at a 6 or 7 multiple like I talked about earlier, for example, in my August of 2012 article, I also was pointing out a time when Aflac was only trading at about a 7 or 8 times earnings. So once again, we've got this 14% rate of return that's occurred since I wrote that article, roughly, more or less. And the point being is that I've had the PE expansion go from 7 all the way up to the current blended PE of 12.5. So I've had very little change in earnings, as you can see down here. There's been moderate growth. 2016 was a pretty good year, but we've had this very low rate of earnings growth. But what we have had to give us the return we've got is a expanding PE ratio, and of course we've had this steadily increasing dividend. But I want to look at dividend growth for a moment. I'm going to expand this out to 15 years and then take a real quick look at the performance report, because I want you to notice that when Aflac was a faster growing company up through 2012, they were increasing their dividend at astounding rates, and their payout ratio was even reasonably low, although about what it's paying out, somewhere around 24 to 25%. But in more recent years, 2011, 12, 13, that dividend growth rate slowed down, and more recently it slowed down to about 5%. So the dividend is growing, adding to my rate of return calculation. As you can see here, a $10,000 investment made on August 31st would have grown to $18,247, or that's an $8,247 profit, but I also would have received $1,700 in dividends that have actually increased each year. So my total annualized rate of return turned out to be 14.3%, and I ended up with approximately a double when you count capital gain plus dividend from this time frame. So this was a nice double, even though we got no earnings growth, and my argument is that it was the excessively low valuation that created that. But that valuation, although still low by traditional standards, is significantly higher than it was when I wrote those previous articles. So valuation on Aflac is getting to be somewhat of a conundrum. I would like to very quickly go into fund graphs, financial underlying numbers, and look at a couple other metrics here that I consider to be also very relevant when you're looking at this company. For example, if I look at financial underlying numbers here, and if I look at price to book value on Aflac, from a valuation perspective, this is one of the lowest price to book values. I'm going to actually draw this as a line graph so you can see this better. You know, it was not unusual for this company to be selling at more than 2 to 2.5 times book or higher. And then more recently, as we get into 2012, 1.5 times book to maybe as high as 2 times book became more normal. And it's currently trading at about 1.3 to 1.5 times book, depending on the exact timing of how you measure that. So from a price to book value basis, which is a reasonably good metric for gauging a company like this, Aflac looks cheap. If I look at it from a standpoint of how the business is working, I want you to know that gross and net profit margins have been doing reasonably well. Gross margins have actually been increasing, and I'm going to say net margins have been pretty much holding their own at around the 11 to 12% range. Got as high as 13% net margin in 2014. So on the margin, it's doing okay. I also want to look at returns on equity. Aflac's returns on equity are holding up nicely. They're a little below what they've historically been, but they're still within a normal range of around 13 to 14% return on equity, off from 17 to 20% in the past, but it's still generating good returns. Now, as I go back into fast graphs, and I'm just going to go quickly through this now, if I judge Aflac as the dividend paying stock, if I look at Aflac from the standpoint of things like free cash flow, what I'm really looking at here is not so much price. I don't care too much about price. I'm actually going to take it off of the graph. What I'm really looking at here is the dividend and whether the dividend is being covered by free cash flow. And you can see that it still is. However, we can also see that free cash flow has also been dropping significantly since 2012. And finally, I'm going to take a look at EBITDA with Aflac, because earnings before income taxes, depreciation, amortization is another good way to value a stock. And so I put the price to EBITDA here. Over the longer run, Aflac was trading at about an 8 times EBITDA. But if I look at just these last few years again, we can see that that multiple of EBITDA drops down to 6 or so. And if I again bring this back to the 2011, 2012, we see that during this more recent time frame, the normal price to EBITDA has only been about 6 times EBITDA. Therefore, at 8 times EBITDA, once again, Aflac would look overvalued here. So this company still has a relatively low price earnings ratio relative to, let's say, the market or historical norms. It also has a very low price earnings ratio relative to its own history. There was a time when Aflac was commanded a premium valuation during its growth years. But more recently, in its low growth period, that normal PE has fallen more to something like 10 times earnings, which would indicate moderate overvaluation. Aflac's a great business. I've owned it for a long time. My conundrum now, I have no intention of selling it today, but I don't know that I'd be willing to buy this stock with this growth rate at a 12 multiple, even though that's still low. I would probably be more comfortable seeing it around a 10 multiple. So Aflac is definitely a conundrum from a value investor's perspective. This has been Chuck Carnevale saying thanks for listening.